Welcome back to EDS, and in this video I'm going to show you the 4 keys to consistent and profitable trading. So as we can see, the first thing is we need to have a high win rate. It's much easier to manage 2 out of 10 losing trades as opposed to 8 out of 10 losing trades. With a high win rate, you only have to deal with a small number of losers, and it's much easier to manage a small number of losers than a high number of losers. So that's the first thing. And the second thing is you need to have a high return on capital. You need to make sure that for your winning trades, you are more than compensating your averaged out losing trades, so that over the long run, you will, and over enough occurrences, you will be profitable. Now, in order to get a high win rate, we're going to be writing options contracts, and in order to get a high return on capital, we are going to be writing those contracts on futures. And because we are going to be writing options contracts, volatility plays a role on option pricing. When volatility is high, option prices are high, and we're going to be writing the contracts, which basically means we're going to be selling them, or we're short the contracts. And whenever you're short something, you want to sell high, buy low. So you want to sell when implied volatility is high, and then play the contraction. Volatility is also mean reverting, which is very, very important, and it's contracting in the market 80% of the time. So when we're selling in high implied volatility environments, we have a pretty good edge. And then the final thing is position sizing, because variance is real, and even if you're doing everything right, as we mentioned, you will still lose sometimes. And if your position sizing is wrong, if your sizing is way too big and you get unlucky in the short term, then that could end badly for you, even if you know how to manage risk very well. So these are the 4 things that you need to be consistent, and I'm going to show you step by step exactly how to implement these into your trading routine. And I'm going to give you a very simple strategy that I use every day, week, month to generate consistent returns. So the first thing you want to do is open up your brokerage account, and you want to pull up a list of futures underlyings that have options available to trade on them. If your broker doesn't natively display watch lists like this for you, then just copy these ticker symbols and make your own watch list. And you also want to have IV rank on your watch list, and you want to order everything from high to low IV rank. IV rank is simply telling you where implied volatility is for that specific underlying relative to the past year. So it's very, very important. It's a key metric we're gonna look at in choosing what to trade. You only really want to look at things to trade that have an IV rank of at least 30. Anything over 30 is high, over 50 is very high. I like to be in the mid to high range. And then you want to also be looking at your absolute IV levels. Futures uses something called span margin. So when calculating your buying power requirements, things like the size of the underlying, the number of the number of shares of the underlying, I guess you could call it, per contract is taken into account. The implied volatility of the underlying itself is also taken into account. So if you do have a smaller account, then you're probably best off sticking with things like currencies, bonds, soybeans, etc. If you have a larger account, then feel free to trade whatever you like. And so what we're going to be doing is we're going to be looking at natural gas. Natural gas here has an IV rank of 57.3. It has an absolute IV level of 57.2%. So we should be able to get some nice premium here, and we're always keeping in mind our checklist of high win rate, high return on capital, high implied volatility and position sizing. So right now we've made sure that we are choosing an underlying that's in a high implied volatility environment. So we are going to make that not green, we're going to make it, say, blue. So this is now ticked off the list, high implied volatility. We know that because of the IV rank. So next we need to make sure that we are getting a high win rate and a high return on capital. So let's go back over to our brokerage platform. Natural gas, is what we chose. So we now want to pull up a list of option expiration dates for natural gas, and the one that we want to pick needs to be between 30 and 60 days out in time. There's one here 58 days away, April 25th, so we're going to open that up. And now we are presented with the options chain. Very quickly, we have calls on the left here, puts on the right. This horizontal orange line shows us where the price of the underlying is with respect to our strikes that are going down the middle here. We have our dotted blue lines which show us our 1 and 2 standard deviation levels. In the top right we have the IV or the implied volatility for this specific expiration date, which is 44.6%, and in parentheses we have the expected move, which is plus or minus 0.61 right now, and that expected move is also visually displayed or represented with this orange vertical orange bar. So let's get into the strategy itself. We are simply going to sell one call and one put. Very simple. And when you are writing or selling options contracts, you basically want price to stay away from your contracts. So if we know what the expected move is, in order to get a high win rate, we simply just need to sell contracts outside of this expected move. The further out you go, the higher your win rate will be. However, the lower your return on capital will be because you are taking less risk, and that's the trade-off. So a nice balance, in my opinion, is to be around the 1 standard deviation level, or more specifically, I like to be around the 15 to 20 delta mark. So you also want to make sure you have your delta column, positive delta on the call side and negative delta on the put side. So let's just go with a 20 delta to start with. So on the call side we have a 20 delta here at the 5.05 strike. We can sell that, and then on the put side we're going to do the exact same thing, find a 20 delta. There isn't exactly a 20 delta on the put side, so we're just going to go with 19 on the put side at the 3.5 strike here. And what you'll notice is we've basically created a range for ourselves, and both of our contracts are kind of in and around the 1 standard deviation level. They're either on the edge or outside of the expected move, and we're between 15 and 20 deltas on either side. And as you can see in the bottom here, we have our net delta on this position of negative 0.02, which is basically delta neutral, and that's good enough for us. So we've created a range for ourselves, and we want price to stay within this range. Specifically, we want price to be within this range at the point of expiration, which is in 58 days time. And we have this green bar here that's now being displayed, and this green bar is our break-even bar, and the green bar extends past our contracts. So this is another reason why we're going to get such a high win rate here. So we collect a premium, which is this number in the middle and at the bottom here, 0.184. So that's what we collect. It's non-refundable. No matter what happens, we keep that premium up front. And in order to calculate our break-evens, we need to add this on to our call strike, which would be 0.184. That's the premium plus 5.05. That's where we get our break-even level on the call side. On the put side, we do the same thing, but we minus it. So 3.5 minus 0.184, and that's how we get our break-even on the put side. So that's why our break-even zones extend past our contracts, because this premium is non-refundable. We keep it. So what's the actual likelihood of making money? So in the bottom left corner we have POP, which is probability of profit. This is our probability of making at least 1 penny on this trade, and it's at 79%. So already we're looking at a 79% chance of making money, and that's if we hold till expiration. But we don't have to. We can get out of this position at, say, 50% of max profit. And P50 is not displayed for futures, and it is for equities, but it's pretty much just always 10 to 15% higher than your POP. So we'd be looking at, a 90% chance of success of taking 50% of max profit off the table at some point over the next 58 days. So overall, our win rate on this trade is going to be between 80 and 90%, depending on how long we want to hold this trade for. You can increase your win rate even higher by, instead of waiting till 50% of max profit, you can get out of 25% of max profit, and you probably have an over 95% win rate if you were to do that. And how much money can we make? So if we were to get filled at this mid price here of 0.184, we would collect $1,840 up front. that would get added to our cash balance as soon as this trade gets filled, and our broker is going to require just under 2.2k in buying power to open this position. So we're going to collect 1.84 and we're going to use just under 2.2 to open this position. So we're looking at an almost 100% return here, and this is in 58 days. This is not over the year, this is in 58 days, and our mid price has just increased slightly, so we collect $10 more. So we've made sure that we've locked in a high win rate, as we've already determined, or as we've already gone over with our our pop and our P50 levels. So our win rate is going to be between 80 and 90%. We've made sure we're getting a high return on capital, because our return on capital, as we just saw, was close to 100%. We made sure high implied volatility, IVR was over 50, and now all we need to do is manage our position sizing, which I'm going to show you how to do in just a second, but I'm going to show you how to manipulate this position even further. So let's say, for example, if you wanted to increase your win rate, you can reduce your deltas. So remember at the beginning I did mention 15 to 20 deltas, so this is the 20 delta level. We can go to, say, the 15 delta on either side. And what that's going to do is, if you look at our pop now, it's increased to 83%. So we're going to have an even higher win rate, but we are going to collect less premium. As you can see now, our max profit, or what we would collect, is 1,350. A buying power requirement is still around 2k. So you can play with it. I generally find between 15 and 20 deltas is a good starting point. 20 deltas is a pretty solid starting point. However, if you did want to be more aggressive, you could go to, say, the 26 delta on either side, and now you're collecting 2.6k in premium up front, and you're going to be using under 2.6k in buying power. So you're getting over a 100% return, and you still have a pop of 73%. So your P50 is still going to be over 80%. It just depends on how much risk you want to take. I personally like to be at around the 20 delta mark. It's a pretty good ratio of risk to return, in my opinion. And just to be clear, your P50 is going to be 50% of your max profit. So if your max profit was 1,850, your P50 is going to be half of that. So that's going to be $925, if my off the top of my head maths is correct. But you get the point. P50 is going to be 50% of your max profit, just so we're absolutely clear on that. Now, as we mentioned, position sizing is key. You need to know how much buying power to use, and in order to figure that out, we have created a free position sizing template that's available for everyone. To get a copy of, the link is in the description. Just click the button and it will take you over to this spreadsheet. The way it works is you enter in the size of your portfolio. So say if it's $25,000, you then enter in whatever the VIX level is. So say if it's 12.4, and then everything's going to be calculated for you. It's going to tell you exactly how you should structure your portfolio. What we went over today is an example of an undefined risk position. So if you do have a $25,000 account and the VIX was at 12.4, you'd want to be allocating no more than $1,750 to a single defined risk position. And obviously, this scales dynamically according to what the VIX is. So if the VIX was at 34.1, the numbers change. It's all dynamically calculated for you. And the reason why the VIX is important, because it shows us the overall volatility in the market. When volatility is high, our edge is high, so we can be more aggressive. And also when volatility is high, the chance of a black swan event reduces. So that's another reason why we can be more aggressive. So as long as you're following this, over the long run, you'll be absolutely fine. If you do want to learn in more detail about what we do and how we do it, for example, learning about how to manage your positions when a position moves against you, because you will win most of the time, but sometimes positions will move against you or they won't be cooperating, and you need to know how to manage the risk on those positions. Quite often when a position moves against me personally, I'm able to essentially manipulate that position and move contracts around and roll out in time, roll up, down, etc. in ways that allows me to turn losing positions into break-even or winning positions. So if you want to learn all the more advanced stuff and even the basics, again, the link will be in the description. This time click on EDS Premium, get yourself signed up. You will have access to one of our portfolios that will allow you to see all the positions that we're placing, how we manage risk, how we make adjustments, etc. Everything is all there for you, and it's all in real time, so you can see everything happening as it's happening. And there's a full course as well, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's a private community, so if you do get stuck at any point, you can simply speak to myself or with other like-minded individuals. And there's a 100% money-back guarantee. So once you have been through the full course and followed our trades for at least 6 months, if at that point you're not profitable, then we will simply work with you for free until you are, or you can just request a full refund. So there's no risk to you. It's $9.99 a month to join. The price was £1 a month. That was for our first wave of members. That's now full. We are now on our second wave of members. Once this is full, the price will be increasing further for the third wave. So you are rewarded for getting in early, and once you're in, the price is locked in, so you don't need to worry about future price increases once you're already inside. And the aim of EDS Premium is to teach you the skill. We want to teach it you. We don't want to keep you dependent on us. Once you have learned it, you can take it with you for the rest of your life. No one can take it away from you. It's very powerful, and we aim to get you to that point of where you are completely self-sufficient within 6 to 12 months. You're always welcome to stay and be a part of the community, but within 6 to 12 months you should be good to go. So with that being said, I will see you guys on the inside.